Hello everyone, I hope you can hear me. My microphone says that yes. So welcome to our Tax Changes 2020 webinar. I'm going to give you a short update about what happens in Hungary and what you can expect the following year about the Hungarian tax system. You might know that we have a conference. We have a conference every year about the tax changes. It was last Friday. Unfortunately, it was in Hungarian language, and that's why we thought it is very unfair against our English-speaking clients. So we decided just to put together all this kind of information into one presentation. And between a one and a half hour, we are trying to present it to you just to be able to have a view about what's going on in Hungary. Of course, it's 1 and 1.5 hours, but it is maybe more than nothing. In the past, you have received already these kind of slides and some explanation about the changes, but we thought that if we can discuss it, then that would be that could be better for you if you can listen to it and if you spend 1 hour just to understand about all of these changes. If you haven't used Zoom in the past, then you can see a Q&A section. If you have any question, then you can post it there and I'm trying to answer it. If I don't manage to answer during this presentation, then we will send it to you or we will reply to these questions as possible. So let's talk about the changes then. I just start the presentation. So what we are going to talk about is the corporate income tax. Here you can see the CIT, changes in the small business tax. This is a quite new tax. It has only just a few years back to Hungary and might not relate it to everybody. Some changes in the VAT and changes in the personal income tax and social security. Usually this last section is in a conference is held by Sylvia. She is the expert in our company about personal income tax and social security together with the very motivated payroll crew of her. So I'm trying to give you details, but maybe this is not my main expertise. But let's talk about corporate income tax. Everybody's really interested how it's going to look like and if there is any big change. I must tell you that at the very beginning that there are some changes and there are some significant changes which doesn't seem from the first few very significant, but later you are going to see that it's going to affect everybody. Going back to the corporate income tax, it is also very important that when our government implemented the small business tax, it has a very clear voice, it has a very clear view what they expected to do, and they want to split the larger entities and the smaller entities. And when we are talking about corporate income tax, it is extremely important that they believe that those larger taxpayers who are under the corporate income tax are able to have enough administrational background and enough staff to do all these administrations. So that's why when we are talking about corporate income tax, there are quite a lot of administration because it is expected by our government that you have the right staff for all of these or the funds. In case of corporate income tax, some of the contents that we are going to talk about, these are trust funds, tax fulfillment obligation, tax designation, interest limitation rule, development tax credit, and some smaller items like energy efficiency tax allowance, supporting the upkeep of sport facilities. Maybe it is not for everybody, but for those it is very important changes. Some change in the concept of the affiliated companies, tax liabilities or for disinvestment. That's going to be a very interesting topic because we don't have it in the past, but it is a kind of new regulation. According to the EU, it is an implementation of an EU regulation. Transfer pricing rules and rules of the tax avoidance. I'm not going to go into very details of every different content. If you have any question in the future about all of these, that you should know that there are changes. So if you have any questions which related to you, that our colleagues, our staff, and me are very happy to help you through all of these changes. So let's talk about trust fund. Many of you know what is a fund. In Hungary, this is a quite new thing, and this is a new structure. What we can say all about it, that, you know, I would say it is really a little bit against the transparency, and the world is going on a different way what we are doing now. But now we have the trust fund, so we can have a fund, and we can have someone who can take all the benefits of this fund. Unfortunately, we don't have Paris Hiltons because we don't have Hiltons here in Hungary. But it could happen that there are some wealthy private persons with some reasonable amount of worth that they want to put their money or they worth into a fund, and this is how they want to help it, their kids or the beneficials. But trust funds are not just for private persons. It also became a kind of governmental stuff. I mean, they created this public benefit purpose trust fund, which means that in the future they can put plenty of different, in the past, governmental related obligations into funds. And these are just like, you might know about Hungary that we really like sports and build quite a lot of stadiums. And for example, stadiums, hospitals, schools, health institutions, social institutions can be put it into funds, into trust funds, and these going to be public benefit purposes. So it is in the future, these are out of the scope of the budget, of the governmental budget, because it is funded by the, because it's going to be financed by the fund, so it is out of the government. Of course, it is a more kind of political question whether if it is good or not for the society. Everybody can decide. One of the most interesting change is the change of the fulfillment obligation. It took us many years until everybody understood how it looks like and why you need to fulfill the corporate income tax on the 20th of the given month of your year, and usually it is the 20th of December. Now it is changed, and they cancel this kind of obligation, which means that even from 2019, you don't need to fulfill the corporate income tax until the expected amount. It is I think it is good for everybody for administration purposes. It means that on the 20th of December, you don't need to deal with the corporate income tax. You don't need to make a guess how much my profit is going to look like and what's going to be my tax, and we are not penalized if we miss this guess, a good professional guess. So it is a good thing. On the other hand, you might know about this tax designation when you say that part of your tax are given for a sport club or for some sport facilities or things like that. It affects on these kind of tax designation as well. That's why the government says that even if it is not obligatory, those who want to still give this tax to for given purposes, they have the right to have this 20th of December tax fulfillment. So for those who make tax designation, they have the right to do it, but it is not obligatory anymore. As you see, the tax designation is going to be also changed. I mean, the percentages, what you can do. In 2019, during the tax advance payments, you can have 50% of all of these SN allowance, 80% during the tax fulfillment, and at the annual tax, it goes up to 80%. In the future, when we don't have the fulfillment, you can use 80% for the advances as well. So it's not going to be a problem in the future. If you have this tax designation, you should also remember that you can earn 70.5% So for those who has a large tax payment, it could be reasonable amount. But for those who have only just a few million hoof tax payment, you can calculate quickly that it is not a quite big amount. So the administration about this tax designation going to be much more than the expected return on the tax, what you need to pay less. But for those who pays hundreds of millions of corporate income tax, then it could be reasonable. It is also very important to know that even this fulfillment cancelled in the corporate income tax, it is not cancelled in the local business tax. So you still need to fulfill the local business tax until the 20th of December to the expected amount. So in one hand, it is good. I mean, the corporate income tax cancelled, but in case of the local business tax, you still need to calculate and you still need to put it in a tax return and pay to the expected amount. Interest limitation rule. This is a quite new rule. It started last year in 2018. I just have an example of how you should calculate all of this. Actually, it is the future of the low capitalization question. So if the company finance itself from loan or intercompany loans, then there is a connection with the tax base increase. So of course the purpose is that to give enough registered capital, enough equity to the company and do not decrease your tax base with unneeded expenses. So that's why this rule happened, and this is the calculation what I have just made. So the example quickly is that, for example, if you have a 10 million hoof, for example, profit before income tax, profit before tax, you have a tax base increasing items, tax base decreasing items, and you have a tax base, let's say 7 million hoof. Then you can check what is your interest income and interest expense related to intercompany, so not bank financing or things like that, but for example, intercompany loans. And if there is a balance, let's say here that there is a net financing of 4 million, net financing cost of 4 million, you have a depreciation of 1 million, then you should calculate the EBITDA, which here it is 7 million plus 4 million plus 1 million, so it's 12 million, and the rule says that 30% of your EBITDA is acceptable, or there is a maximum amount which is calculated from euro. I cannot tell you the euro number, but it could be around 3 million euro. So it is, when the rule was set up, it was 938 million plus amount. If it is above of all of these, then they're going to be a tax increasing item. So when we calculated it, here is that 30% of the EBITDA is 3,600,000 hoof. We have the 4 million net financing cost, which means that they're going to be a tax increasing item of 400,000 hoof in this special situation. When I make this stars next to this tax base and increasing, decreasing items, you shouldn't consider, of course, this financing or this limitation rules during this increasing and decreasing items. So this is why I have this star here. So this is the simple calculation for all of this. It means that if you have intercompany loans, then you need to check the net financing, check the EBITDA of the company, and then check the 30% whether if you need to put any tax increasing item or not. If it would be below, if the financing would be below this 30%, then you don't need to do anything. But because of it is above, then here you need to put it in your corporate income tax return as a tax base increasing item, and you need to pay the corporate income tax accordingly. Development tax credit, actually it is the changes are related to small enterprises, small and medium-sized enterprises. What happened that if you have development in the past, until the end of July, it was a 500 million hoof. So if you have a 500 million hoof investment, then you can receive a tax allowance for this. And based on this tax allowance, in the following 14 years, you can decrease your tax base. What happened now, they decreased the investment, the size of the investment. So until the end of December, 300 million for small enterprises, for medium-sized enterprises going to be 400 million, as you see, and it's decreased until 2022, 50 million hoof investment or 100 million hoof investment in case of medium-sized companies would be enough to get a tax allowance. The calculation of the tax allowance is another tricky one, because it means, it talks about that this is the investment what you need to have. Usually and generally 20% of the investment accepted as a tax allowance. I'm telling usually and generally because it depends on which region it is in Hungary, what is your industry and what you are doing and what type of investment, but at the end, let's say generally it is 20%. So if you have 100 million hoof investment in Hungary and you are a medium-sized company, then you can expect, for example, a 20 million foreign tax credit. It means also that 9% is the corporate income tax in Hungary. So only if you don't have 100 million hoof profit before tax in the following years, then totally, then or altogether, then you cannot live with this tax allowance. Of course, it is also important that you cannot decrease your corporate income tax base into zero. You can use this 80% rule, so you still need to pay the tax after the 20%, so you cannot have 100% tax decreasing. You always have to pay something to the government. Some changes in the sport facilities. It is also related to this tax designation. So in the past, you can only give part of your tax just to build stadiums, let's say. Now you can give it also to maintain these or to upkeep these facilities. So it is a big change. Maybe it is going to solve the operational questions of all of these facilities. Of course, these are different sport facilities, not just football stadiums, but also related to hockey, to basketball, and there are seven marked sports which is favorable in Hungary, and for those they can have this kind of tax allowance. The other change that in 2019, 2020, it is 50% was available for this, up to 300 million forints, and they increased it 2020, 2021 into 80% and up to 600 million forints. So they have more funds just to maintain and run all of these facilities. There is another change, but you are going to see during the personal income tax changes, because you might know that Hungary is also involved in the European Cups, so we are going to organize a few games. That's why for the government it is a priority to have the right facilities and the right people for that. Tax consolidation. It could be important for those who has more than one entities in Hungary, because the tax consolidation means, the corporate income tax consolidation means that you can add together all your company's profit and loss statement, and you need to pay only the corporate income tax based on this consolidated amount. So if you have one company which has loss, you have another company which has profit, then you can add it together and you need to pay only just the net of this loss and profit, which is a good thing. In the past, they need to be 100% affiliated companies, so it is decreased to 75%. So it doesn't, in the future, it is not necessary to have 100%, the same 100% ownership structure, so 75% would be enough. There are some still other requirements, just like they need the same balance sheet date. So if you have a different calendar year, then you cannot do it. You still cannot do it. You must have the same accounting system. So if you use the Hungarian accounting and IFRS, then you cannot do it. Only if both of the companies are under the Hungarian accounting, or both of the companies or all of the companies are under IFRS. What is changed is that the currency, in the past they need to have the same currency. Now it is changed that different currencies would be acceptable. So if you run on your accounting and your primary currency is euro, and you have another company which has Hungarian forint, it is not a problem anymore. In the past they couldn't choose this consolidated taxation. And of course, the main benefit of all of this, and many of the firms choose this tax consolidation, is the transfer pricing. Because if there is a group and they are using this tax consolidation, then they don't need to prepare transfer pricing documentation, and the intercompany charges shouldn't be under, or it is not necessary to be under the marketable price. So many firms, it is a very useful thing because they cannot use really the market price between each other. And of course, one has a profit, the other has a loss, and now they can consolidate it. And I think it's a good solution for that. What I put here is the Google structure. This is Google's corporate structure. It is on the net, so you can see. So for them, if, for example, let's say the fiber company has loss, and if they would be under the tax consolidation, then this loss can be accounted in the group, and then they don't need to pay more corporate income tax just because they have separate firms and not one firm. Some change about the affiliated companies. In Hungary, the general rule was that 50% of the ownership was the main rule of an affiliated company. Due to EU legislation, the 25% affiliated company rule comes into effect again, but it is just for specified situation, just like when there is a controlled foreign company, separate taxpayer in terms of taxation, increasing items related to certain income of controlled foreign company, and disinvestment. So the 25% is only important in these cases. And we still have the same regulation if 50% affiliated company means if direct and indirect portion of voting power, direct, indirect share ownership, profit sharing. So in that case, the 50% affiliated companies definition works. So actually it doesn't affect too many people. Maybe the most important part is this disinvestment. I hope no one going to see what it is, but I'm going to tell you a few words later what is this investment. The 25% rule is because of this, I think, because if somebody want to take out the investment from Hungary, again, it is not a Hungarian regulation, it also comes from the EU, so it is, I think it is for everybody. So if someone want to change the core company seat, move the business from one country to another, this is a disinvestment. And when you move your business out of Hungary, then it would be important to determine who is an affiliated company and what kind of tax base, increasing, decreasing items you should account. And for these purposes, this 25% rule is a more strict rule than the 50%. So as I mentioned, just a few words about this disinvestment. It is very important that if you move your assets in any reason out of Hungary from your company because you want to do the business on a different business location, move it from Hungary to, let's say, Romania or whatever, move some of your asset, then you can calculate and you can expect that you are going to have a tax correction on your corporate income tax return, which means that you should account into the corporate income tax return that the profit which is not accounted during the period, but will never, because if you move your business, so it is a kind of safeguard for the governments not to have too much disinvestments in a given country. It is an EU rule. I think it's going to be sooner or later the same everywhere. Now we are going to have from 2020 in Hungary. These are the keywords what you need to know also. I mean, there is going to be Energy efficiency tax allowance. So if you think about some energy efficiency investment, then you can expect some tax allowance. We can help you in all of these. If you grow and you have a reasonable corporate income tax, then you can have some tax credit. I was talking about local business tax. The major change, of course, is that, or it is a not change, so you need to still fulfill the local business tax. And in case of the transfer pricing, this consolidated corporate income tax base is a kind of change, so you can calculate with it. If you have a consolidated tax base with a group of companies, then transfer pricing doesn't affect you. And this tax liability for this investment, what I mentioned. So if you plan to move any of your business out of Hungary, or even anywhere in Europe you want to move it, then it's going to have a tax base correction everywhere, I think. Small business tax, I don't want to talk too much about it because, you know, it is very hard to choose for foreign entrepreneurs. Small business tax is for small taxpayers, but there is a change. I put this graph here, so it decreased the small business tax change from 13% to 12%. Actually, maybe it was a kind of joke in Hungary because the government in Hungary often use this kind of graphs. When there is a very small change, they put together something completely different thing, and it is just a kind of Hungarian joke. So you can see that there is only just 1% decrease, and of course it is not this huge amount, but there is a kind of tax reduction in this. So this is the only change in case of small business tax. But what we can see, and especially during our audit engagements, that many firms who are not liable to choose this small business tax, they choose it, and they started to do it during the year because the tax authority just accept without any review if you want to move to small business tax. And when we are coming during the preliminary audit, we realize that you were not liable to choose this small business tax, and then a huge amount of self-revisions happens, and so on and so on. So even if you wish to choose, or if you wish to change to small business tax, which is a very favorable tax in Hungary, of course the amount is 13% is one thing. Comparing to the 9% corporate income tax, it is higher, but the benefit that it is really cash-based, which means that if you don't have change, if you don't take out the cash of the company, you don't have to pay the small business tax. Only if the owner is taking out the money of the company, then they need to pay this 13%. In case of corporate income tax, doesn't matter if you have dividend or not, you have to pay it. So for those growing companies who doesn't want to take out the cash, it is a better solution. But to choose it, it is very important to go through on all the possibilities and figure out whether you can choose or not. Value-added tax. Actually, there are not too much big changes, some favorable changes. It is, I think, also for the whole Europe. What happened is there is this Enzo di Maura European Court decision, 2017 happened, and the Hungarian VAT system react for this change, and from 2020 it has changed on the VATs. What happened during this situation, and what was this court decision, that this Enzo di Maura, what happened for them, they applied against the tax office decision that they don't want to reclaim the VAT for them for an unpaid invoice. So in the future, or not just in the future, but if we are going back for the past until the until the very beginning of 2016, if you have an unpaid invoice because one of your customer go bankrupt, there was a cancellation or anything else, then you can go back and check if you have already paid the VAT for that invoice. And if yes, you have the right to deduct or reclaim this VAT. So you can do it from 2020. Only when there is a taxpayer. So if it is a private person who doesn't pay you, then you cannot do it. You don't need any invoice correction or anything like that, but you need to check whether the invoice, the delivery date of this invoice, the completion date completion date of this invoice is after the 31 of December 2015. It should be due for at least 1 year. It is also important. You should account it as a bad debt, and then you can reclaim this VAT. I think it's a good thing, and everybody must check if they have such a situation, because if yes, then you can reclaim quite reasonable amount of VAT. You must do it. If you have the situation, if you have the calculation, we can help you with all of these. Of course, it doesn't relate it to independent parties. So if there are if there is a bad debt within independent parties, then you cannot use it. It is also very important when you do it, you need you need to prove that it was a bad debt. Of course, the best proof if you have if the company is cancelled already, so it is not in the registration, or if you have a paper from the liquidator that they don't have enough money just to pay you. If it happens, then that's fine, and then you can reclaim it. So it is very important to review all of these documents, and afterwards just to start this process. But if you do it, you can get back, I think, reasonable amount of money. For some enterprises, it is a very good change. There is also another change. It is also a European court decision. It is related to a Hungarian apply for against some of the Hungarian tax authority decision. What happens here, that this private person in Hungary, it was a taxpayer, and in both during a tax authority, how you call it, so the tax authority started an auction selling something, and this person, Tibor Farkas, bought, it was a kind of mobile hangar, I don't know what is the right word for it, so it was like this, and the seller invoiced this with a direct VAT for him. The seller paid the VAT, Tibor Farkas want to reclaim it, but the tax authority says that it was a mistake because the seller should invoice it with a reverse charge VAT. And whatever he says, that even the seller already paid the VAT and why he cannot reclaim, the tax authority levied a penalty on him because he was not liable to reclaim the VAT and he couldn't get back the VAT as well. The tax authority says that he must go to the seller and ask back this VAT. I think it is unfair, and the court says also that it is unfair. So in the future, if something happens and it is a formal mistake, so the seller paid the VAT, then the buyer can reclaim it if the seller paid the VAT to the tax authority. But it is not, you shouldn't do a self-revision if it happens only on request. The good point also that if the tax authority realizes it during a tax revision, you still have the possibility to do this request. So if there was a mistake and you don't know that it was under reverse charge VAT and you paid it according to direct VAT, then you still have the possibility to do this request, and then they can accept it, and you don't receive any penalty on it. Actually, we have some cases also in Hungary in our company when it was a kind of EU transaction that the company should have a Hungarian VAT number. They don't have. They charge it with the EU transaction VAT, the other one charge it with direct VAT, and the tax authority penalize the one who charged it with the direct VAT because the other entity should come to Hungary and register under the VAT, and it should be an inland VAT. So it is always a very complex story, but at the end, the tax authority is not going to penalize for those who make such a mistake, and it is not a kind of fraud or something. So it is absolutely a mistake or misunderstanding. You might also know about the quick fix steps of the EU, and there is also some implementation regarding this in the Hungarian VAT legislation. The exemption rules for sales in the community, it is a change. Documentary evidence of delivery, changes in the chain transaction rules, change in customer inventory rules. What I'm going to talk about is something about the documentary evidence of delivery and changes in the chain transaction rules. The documentary evidence of delivery, it was a big mess, I would say, because the tax authority had a list, or it was even in the rule what documentation they accept if the goods moved out of the EU or go to export. And it was also a EU decision, and this is why it happens, that in the future the tax authority cannot decline that it was an EU transaction just because you don't have the document what they expect. It says that two non-contradictory evidences are enough. So if you have a CMR or an insurance policy, a bank document certifying the payment, so if you have evidences that you show that the goods are moved out of your country to a new country or out of the EU, then that would be enough, and the tax authority must accept that it was an EU transaction or an export transaction. Sometimes it was very hard, and we were chasing some documents just to be able to prove it to the tax authority. Sometimes it was impossible. Now, if you have two non-contradiction, I couldn't say this word. So if you have two different documents, two evidences that proves that the goods moved out of your country, then this should be acceptable by the tax authority. The change in the transaction, chain transaction, actually it is a kind of simplification, and I have an example for you what you can expect. The example is we have a Polish company and it delivers goods to a Romanian company, and we have 6 different type of possibilities what's going to happen. The first example, when the Polish one company transports the goods to Romania, the new chain transaction rule says that only one transaction should be under, in a chain transaction, should be under EU transaction, so intra-community transaction, and the other ones should be a kind of inland transactions, and this should determine whether which company and where should have a tax registration. And now the rule going to be quite clear. So the first case, when the first Polish company transports the goods to Romania, then it means, and let's say the Polish 2 company and the seller, the seller, the Polish one transports the goods. This means the Polish 2 company should register in Romania because the goods are going here, and if this company doesn't use this Polish tax number, then it should have a Romanian tax number, and it means that this transaction going to be an EU transaction without VAT or reverse charge VAT. The Hungarian company should register also in Romania, and between the Polish 2 company, Hungarian company, it's going to be a Romanian inland sales, and of course the Hungarian and Romanian going to be also Romanian inland sales. So only this transaction going to be reverse charge VAT transaction between the EU. Then PR2 transports as a customer. It means that the delivery is also to Romania, which means also here this transaction going to be the EU transaction and the rest going to be Romanian inland transaction. But what happens if PR2 transports as a seller? So the transportation ordered by Polish 2 company. This means that here there is no transportation, which means that it is Polish inland VAT, whatever it is happens, and this going to be the EU transaction. So between the Polish 2 company and the Hungarian company, it is an EU transaction. The Hungarian company must go to Romania and have a Romanian VAT number. And between the Polish EU number and the Hungarian Romanian VAT number, this should be an EU transaction. And of course, between the Hungarian company and the Romanian company is going to be an inland Romanian transaction. I know it is very hard, so you might listen several times, but it's worth it. What happens if the Hungarian company transports it as a customer? The same situation, because the transportation happens here. So it's going to be the same what I mentioned before. It is absolutely the same situation. What happens if the Hungarian transport as a seller? So the transportation happens here. Then it's going to be the Polish one company, inland VAT to Polish two, and the Hungarian company must go to Poland. And in Poland, he needs a VAT number, and it's going to be, of course, an inland Polish VAT. And this is going to be the EU transaction between the Hungarian and the Romanian company. And if the Romanian transports, again, it's going to be the same situation. So the EU transaction happens here. So as you can see, if there is a chain transaction and there are more than 3 members, of course, because if it would be 3 members, then maybe it could be a triangle transaction. But if there are more than 3, 4, at least 3 different countries involved, then it's going to happen that one of the companies, at least one of the companies, must have a VAT registration in a different company than its own. And especially the one who is not, as you see from these examples, where the transportation is not involved at all. As you see, that company, the Hungarian company, could be sure that during this transaction he needs, or it needs, a Romanian or a Polish VAT number. It cannot do it without any VAT number, a Polish VAT number or a Romanian VAT number. So it is I think it's a simplification, and it is better to understand where you should have a VAT registration and what you should do. Of course, there is another rule which says that this, if the Hungarian let the Polish two or the Polish one know, the Polish two know that it has a Polish VAT number and it want to have this transaction according to that, then the Polish inland VAT happens. But in that case, the chain transaction is a little bit different because it is not really a chain transaction anymore. So, about personal income tax and social security changes. Let's start it with the minimum wage, because in Hungary, you might know that many social security related to minimum wage, and even if you don't have a salary, you need to pay the social security according to the minimum wage several times. So it is very important in Hungary what is the minimum wage looks like. Until now, we don't have an official statement what's going to be the minimum wage in 2020, but in the past it was communicated how it's going to look like, and this is what we are going to tell you now. So the minimum wage in Hungary was this 149,000 HUF in 2019, and it's going to be, and it's going to, or expected to increase to 160,000 forints, 160,920 forints. It is important that it is calculated about the hourly rate, because many benefits are calculated according to the minimum wage, so it is an important number in Hungary. Of course, in Hungary we have the minimum wage, and there is so-called guaranteed minimum wage. The difference between the two is the guaranteed minimum wage is for those who need a kind of special certification for their work. Actually, everybody needs it. So there is nobody who usually can be under this minimum wage. Maybe cleaners or very low educated workforce or black collar workforce could be under minimum wage, but the rest of the people are under guaranteed minimum wage. As this guaranteed minimum wage in 2019 was 195,000 HUF. In 2020, we expect to have it 210,600 HUF. So it is also a nice increase. But But usually what happens in Hungary in the employment market, that they increase a little bit higher than this. The personal income tax rate remained 15% in 2020, but we heard some news about it. I don't know if it is true or not, or what they are planning to do, but there is also a kind of communication that in the near future they want to decrease it under 10% to have the lowest personal income tax rate in the EU. So I don't know what's going to happen, but we still have this 15% personal income tax rate, which is, I think, quite good according to other member states of Europe. But you should never forget that this is the personal income tax rate, and we have plenty of social securities which is payable. So even this 15% sounds very good, but altogether what we have different social security rates, the total deduction from an employee is going to be, generally the total deduction is more than 30%, and plus the companies must pay social security above all of the gross salaries, which is, in case of, if they use the small business tax, is going to be 12%, but if they are under social security, it is more, a little bit more. And of course, even if we have this small income tax rate, we still have some possibilities for allowances. And one of the newest allowances is the mothers of 4 or more children. You can imagine this. I have 3, but 4 or more, that's extremely too much, or not too much for everybody, but I can expect which is the mother who can work with 4 children. We have the family tax allowance, first marriage tax allowance, and some other personal tax allowances. But the new one is the tax allowance for the mothers who have more than 4 or more than 4 children. We have quite a lot of presentation about all of this. I don't think that too many people are going to have this kind of tax allowance. As 4 kids are quite a lot, but it has very strict rules, and what it says, and actually this is the most important, those mothers who have 4 kids or more are not going to pay personal income tax during an employment contract or when they receive salary. So it doesn't relate it to capital investment income or things like that. It is only just for salary type incomes. So the ones who receive salary type incomes and have more than 4 kids, those mother doesn't pay personal income tax in 2020 or from 2020 January 1st in Hungary. There were quite a lot of jokes in Hungary that we are going to somehow, import ladies with 4 kids, and then it's going to be a very tax beneficial income for those ladies, and maybe many of the European countries, people going to move to Hungary just because of it. It is not as easy to receive this tax allowance because it is also related to get some social benefits on your kids, so it has some detailed rules as well. But at the end, of course, those people have quite good possibilities that they are not going to pay personal income tax. But this is not a huge amount of people, so I don't want to talk too much about it. If someone is interested, of course, we can have, and we can make some calculation how it works and what it's going to be. Family tax allowance, Hungary is trying to be a very family-friendly country. We have family tax allowances, which means that if someone has a kid, here you can see 1 kid, then they're going to be a tax-based reduction according to these amounts. You are going to have these slides so you can see it is mainly related to your employees, and of course your payroll going to calculate all of this, so you don't have to do anything or too much about with this. We are going to calculate, or the payroll going to calculate all the benefits what a family can get. It is important that those people who have more kids going to get more net salaries than the ones who doesn't have, and that's what this is the only one thing that you should consider, that if you have two people have the same salary in gross amount, so you are going to be fair, but the one who has more kids going to get more net. This is what you need to know. And because of this, of course, you know, it is also a kind of how can I say, motivation to the people to have more kids. I told you before that there is some connection with the EU Football Cup and the tax changes with the stadiums, and also in case of personal income tax. So in 2020, all the payments which are related to this European Football Association going to be tax exempt. So if you are doing anything for the UEFA or helping, being a volunteer or doing anything during this UEFA World Cup, then those people personal income tax is going to be zero. And if some of you are playing football and receive a prize in Hungary, it's going to be also 0% income tax. So cash prizes, any benefiting kinds, what people receive during all of these, and everything is going to be tax exempt. So it's worth it to have income from these type of sources. And of course, it is not just for the football, but there are going to be other sport events in Hungary, and they just told that it would be also good to have these kind of allowances for those sport events. We are going to be, for example, next year, as far as I understand, we are going to have a World Cup, Athletic World Cup or something. So it is also related for that. As you see, Hungary is a very sporty nation, and we want to have good paid sport people and give benefits from all of them, not to pay taxes. Cafeteria benefits are more important maybe for you, just to understand how it's going to change, and they're going to be no big change. So you still have to pay quite a lot of social contribution and the same personal income tax. There is just only one change which happens during the year, that 2% decrease was from the 1st of July in the social contribution, but it is related for the general decrease of the social contribution. So this means that from the 1st of July, but it is for 2019, you have 2% less social contribution payable in case of the fringe benefits and in case of specific defined benefits. But altogether, you can see the social total charge is going to be 32.5% altogether in case of fringe benefits, and in specific defined benefits, 38.35%. So it's if you give anything to your employees of benefiting kind, you can expect that you are going to pay these amounts if it is not payable according to their salaries. So that's the difference. I just mentioned here that this was the change, that the 1st of January there is a change in the total social security in 2019, and this is how it is related. And as you see, in 2020, there's going to be no change in that. So what happened in after 1st of July, it's going to be the same in 2020. So this is what you can expect, and there is no more benefits. So the type of the benefits doesn't change. So day nursery support, kindergarten services, entry ticket pass to sporting events and cultural services. Be aware that this is the tickets. You cannot give coupons for this. Those are not tax exempt or tax free. Only just the tickets itself are tax free. There was, and we still have this risk life, accident, and sickness insurances. You must take care about the insurance companies because they love to sell their products, and usually they trying to put everything that it is related to this, and the company doesn't have to pay any taxes afterwards. Almost every time it happens that our clients come to us and ask us just to review the package which is recommended to them, that at the end it comes out that they need to pay something afterwards. So it is very rarely happens that there is no payment or benefiting kind payment of insurances. These insurances are really the basic insurances. So those, if you want to have an insurance on your employees, that if someone broke the hand, then it's going to receive 10,000 forints. So it is like that, but not any investment type of insurances. For those, it is not exempt. Those are not tax exempt. So you need to pay the taxes afterwards. No changes at all. And in 2020, it's going to be taxed. This is the housing benefit for mobility. In the past, it was tax exempt. Now it is taxable. House purchase allowance, it was also a kind of good benefits, not tax exempt anymore. Student loan. Student loan is that if someone has someone who was under university or high school or whatever, they can get a loan during their study and they need to pay it back. And it was a rule that if the employer pays it back or has on the repayment, that they can have some, then they don't have benefits on that. Now it's changed. Risk, life, accident, and sickness insurance is also a change, that there are going to be some payments afterwards. And we just talked about this, you might know this state change rest card, the limits, about the limits and how you should pay and what kind of tax after all of these. If you are under the preparation of your cafeteria policy and you want to change anything within it, or if you want us just to review and help you in that, we can help you. But of course, you can see on this presentation and you will receive it. And if there is anything which is reliable to you, then here it is. I think in the future, these cafeteria things are not beneficial for financial purposes anymore. If you want to motivate your people to do something, just like if you want them to go and have a rest in a hotel and you don't want to give them money, but you want to give this amount for them, then you can motivate to go and have a holiday. So maybe from a tax point of view, it is not, these are not benefits anymore. And in case of cafeteria, I think this is it. So the total charges on specific defined items, as you see, is almost 40%. So it is almost equal just to give a salary to somebody, which means that you can decide if you want to give these kind of benefits or give salary instead. It is really a question of your wage policy, what you plan to do. And I think this is going to be the end of this presentation. I hope you have enjoyed and hope you have quite good information about all of these. I hope these changes are not too big, but of course it affects on many of you. But at the end, you know, I believe that at the end there are no huge changes in Hungary, which is also a good thing because you can plan. And if you can plan with all of for the future, then you can make your business more stable and it is much easier for all of you to do business in Hungary. If you have any question, then we are happy to answer you. I hope really you have enjoyed this webinar, and we are expecting to have some more, maybe shorter ones on specific items. So you are going to be always invited. And thank you very much. Bye-bye.